Well, I'm not surprised that we've seen this recoil with 150. Did the Bank of Japan intervene? I suspect that they did. Certainly the sound bites that have come out of the various mob officials are very similar to that which followed the first interventions that we had in September last year. If you go back, last September, I think BOJ sold about $20 billion, and in October, over $40 billion. And at the time, there was no public admission that intervention had taken place. I did think it was interesting that the comments from Mr. Kanda, the currency czar, that effectively the scale of the move up so far this year was of some relevance to their thinking about the currency. Remember, dollar yen's gone from 130 up to 150. That's a 15% move, which sort of gives a lie to the notion that it's purely, so-called speculative excess or speed of moves that's important. I think levels are clearly important here. I think above 150 is politically unpopular in Japan, particularly in an environment of rising oil prices and therefore rising fuel import costs. So I'm not surprised that we saw that reaction. I suspect it was intervention. Will we find out? We'll find out probably on October the 31st when, we get those numbers will come out from MOF. So anyway, in the meantime, obviously, it's going to leave a lot of caution around whether we're going to go back to 150. The intervention threat is very real there. But unlike last September, October, we've now got a rising US yield environment, and in September, October last year, US Treasury yields were falling, so it was easier for dollar yen to fall back with that assistance from intervention. This time, things are very different.
Yeah, and which is why the way forward for the yen is important to ascertain and understand from you, because obviously keeping market forces in mind, the DXY index is going at 107. After the euro, the yen is the most weighted on the DXY, and so I wonder, what that means, because obviously the rate differential story also is at play here.
Oh, absolutely. And, that is still the underlying driver here. But also, you mentioned in your, in your intro there about long duration assets. What I'd also note, and you can see it in the monthly capital flows numbers that we get from the US Treasury, that what we saw in August, so the numbers are a little bit out of date, we saw a big rise in foreign demand for things like Treasury bills and money market deposits. Although, the narrative has all been about this sort of long duration attraction of US Treasuries. I think also just the fact that short rates are so much higher there, and when we have risk-off markets, it may not be that foreign investors are exiting from US equities and exiting the US full stop. They may simply be rotating into short-term assets that are yielding them 5%. So it just sort of serves for the time being, I think, to reinforce the overall sanctity of US dollar strength.